You want me to share it?
Yeah, I think we'll share the presentation. Hey, everybody. Happy Truflation Nation or Truth Nation, Truth Network, whatever we're calling it. Again, it's Happy Tuesday, first Tuesday of the December 10th. There's only one Tuesday on December 10th, 2024. But anyway, yeah, look, we're back. Just really wanted to share with you some of the ongoings of what we're doing at Truflation, especially Oliver, a lot of the work that he's doing with his team. By the way, just for the record, I'm Stefan Roost, founder and CEO of Laguna Labs, who are the development arm building out the Truth Network and Truflation, which is the computation and calculation of indexes off the data of Truth.network. And so, yeah, Oliver runs a lot of our data science around the truth, extracting data from the Truth Network, and ultimately is the lead behind our CPI calculations across the US, the UK, Argentina, and India. So, super happy to have Oliver here and share with us what he's been working on and what he works on every single month as we try to get better in predicting where the government BLS number comes out. And as we all know, tomorrow, Wednesday the 11th at 8:30 a.m. Eastern Time, the BLS will announce their inflation number. And so Oliver compiles every month a report that he shares with paid for customers. And because it's coming to the final month of the year and we're entering holiday season, we want to wish everybody season's greeting and Merry Christmas and offer a Christmas present and share the insights that Oliver gives for paid customers. You get a quick snapshot on the spaces that we offer usually, but given it's the last month of the year, we're not doing a spaces this month. Sorry. So instead, we're going to give you the full blown breakdown of what Oliver has to present. So welcome, Oliver, and thanks for sharing this with everybody.
Yeah, thanks for having me here, and it's good to be here. And yeah, it's Christmas tidings definitely as we come to we're in the into the holiday season. We just had Black Friday, and consumers are spending, so it's good news.
Yeah, so it's good to see the economy's going, and I think just everybody always anticipates what Truflation's leads and insights are, and ultimately they try to get some sort of alpha and advantage associated with it. We've had a number of customers that you've already presented to, right?
Hmm.
And yeah, you've shared your insights around that, which is obviously really what we're looking forward to, and I think the whole community is excited to see. So maybe without me saying too much now, and given the timing, maybe you just want to share with the team sort of the 5-6 slides that you share around the state of the economy as seen by Truflation, trying to interpret the mindset and the thinking associated with the BLS, the Bureau of Labor and Statistics.
Yeah, sure. So, as Stefan mentioned, every month we put together a an inflation report which amalgamates the about 18 million items we track for the US of prices of goods and services. We take all that data that we get updated daily and we create a daily monthly forecast. So every day of the month, our forecast gets updated. At the end of the month, we put together this report that you're seeing in front of us that we take through some of our clients through to give them an understanding of what our longer term trends are. And of course, they get it far more in advance than we're getting to see it today. But at least, it'd be good to share this with everyone ahead of the announcement tomorrow. So I think
So just
the bit.
again, just I think one thing that a lot of people don't realize is that it's December 11th when the government announces the number for November inflation, right? So we're again 2 weeks delay to the actual numbers, whereas on Truflation you get daily updates just to emphasize and remind people the difference between the reporting timings and horizons.
Yeah, 100%. So I think that, without going too quickly into it, I think the overarching theme is as we at Truflation have been predicting, Inflation is not going away. We had predicted back in July that as of September, inflation will be coming up, and it's exactly what we've been seeing. And it shows no sign of abating. In fact, it looks like it's going to be accelerating. And with the Trump administration coming into Q1 in January, and the impact of the Trump administration on their policies and their economic views, we're likely to see inflation stick around a lot longer than anyone had anticipated. And it's now just a question of how much inflation is going to be occurring as a result of the demand that the economy has generated, but also as a result of some of the economic policies that come around the corner. So without further ado, I think the major headline news is that, we're certainly expecting inflation to accelerate. We are expecting inflation, as the BLS reports it, to come in at roughly around 2.7%. Their forecasts are ranging from 2.6 up to 2.9, but the consensus is around 2.7. And I think that there are a couple of key thoughts that I wanted to dive and share with everybody here. I think the first one is core inflation is what's growing, and core inflation is generally a lot more stable, less volatile than the non-core categories, which has the volatility, and hence why we created a core inflation index, which removes food and energy, which are a lot more volatile. So the fact that we're seeing core inflation accelerating, and it's accelerating now up to the level of our forecast prediction at 2.7%. So it gives you an idea of the impact that it's having across the board. So I think,
Just so for people's understanding of why do they call it core and non-core, just because of the volatility? Because in the end, we all need food and energy to survive. Without food or energy, that is core to our survival.
yeah,
Why
so
isn't that considered core, and then non-core being all the other stuff?
So there's a needs-based. So Truflation has a needs-based calculation method, which looks at the things that we need on a daily basis versus things that we are not sort of compulsory purchasing categories. And those are the types of categories that we can maybe relax or forgive a bit, or delay a purchase, or downgrade. Whereas as you said, on food, on healthcare, on communications, and energy, you need them. So there's a needs-based calculation that we have as well. But I think overarchingly, core, the reason why they use core is it gives you a pretty good understanding of where inflation is going from a stability standpoint of view, and a broad spectrum of services and goods that are much more stable, and that gives you a pretty good indication. Whereas food and energy, there's a lot of volatility in that, whether it's the volatility in the commodity prices that goes all the way through, for example, into the price of petrol or gas, or it's on food, which the commodity prices of corn or wheat or hog or any other commodities that affect the prices that we buy in the supermarkets or the restaurants today, tomorrow, next week. So it's the non-core, I'd say, are high volatile, but they impact inflation much more instantaneously and are less stable. And that's why they produce this core index. Why they call it core, I think there could be a different language they could use, but that's the principle behind it.
Interesting. Yeah, I think it's always confusing. And I think, a lot of people get also confused how Truflation calculates it, right? Because we have 12 categories versus the government's numbers, which are 6 categories. Also, we separate out a lot more of the volatile assets, e.g. food as its own category, e.g. Utilities as its own categories, away from shelter, right? And whereby the government combines shelter and utilities into one under the shelter umbrella, mainly because of that volatility. So you can actually directly see and see where the movements are more volatile than in other categories.
Yep.
Yeah.
So I think, that's the core fundamental here, is that the core index is accelerating, which generally tells us that there's a much more broad spectrum of inflation going upwards, which to us is not a surprise because of the cost of the labor market's been really tight. And so therefore we've always expected services to be strong, and it has been, it's continued to be in. What is the surprise is the level of acceleration that we've seen in the goods category. right? And the goods are things that you buy today, not the services, but the goods. And those goods are accelerating at a rapid pace. And I think it's that's more the surprising factor, and that's also driving up inflation, which then suggests that there's much more of a demand-driven inflation that's occurring in the marketplace than we had anticipated, versus services. Now, services have always been strong, but they haven't shifted as much dramatically as goods. That's certainly something to be mindful about. And I think, we're expecting the longer term inflation as we go beyond today and looking at the forecast for what the government will report tomorrow, i.e. the 11th of December, for the November number. We're looking at December, January, and February, and we're seeing the tight labor market and also the wage growth that comes with that, and the continued economic policies that are currently in play to continue to drive inflation upwards.
So with the wage growth, I'm assuming that's going to stimulate consumption, right? It's going to help drive consumer items. We've got holiday season right now. We've had Thanksgiving. We've had Black Friday, Cyber Monday, and we're going into the festive season where people will be traveling or, eating a bit more, having time together with the family in general, right? That on the flip side, though, when you say in the previous slide, when you talk about key drivers are need-based categories, so food and utilities, which would imply that non-core is going up faster than the core inflation. Is that right?
No, so core is going up faster than non-core at the moment, but there are
Okay.
certain categories if you go look at it, like we discussed earlier, that needs-based evolution, that
Yeah.
needs-based categories are accelerating. It's
Okay.
healthcare. Healthcare has been accelerating like crazy over the last couple of years, and more than the last couple of years actually. And it's not going to stop anytime soon for a number of reasons, but we'll get into that a bit later on.
Okay.
Household durables the same. People are they've delayed upgrading some of the household structures, their kitchens, for example, their lawns. They've delayed upgrading hardware, like TVs and durables and white goods, and that's now starting to come through now. Some people are starting to buy those products now, and I think is also a bit on the anticipation that those prices of those goods are going to continue to increase, and people are looking to buy them now versus later.
Interesting. Yeah. So your TVs, your washing machines, your lawnmowers,
Your microwaves, your
vacuum
ovens,
cleaner, microwaves.
yeah,
Interesting. Yeah.
yeah. So then back to your point, actually, which is it's a nice leading question on to the next point, which is how are consumers spending, right? So I think, what we're seeing is consumer spending is up month on month, and it's not abating, right? It's on a constant increase of 0.4% per month. We've seen it last month. We're seeing it again this month. We saw a strong September. We saw a strong August. We saw a strong summer. And right now, this is based on October numbers. You're going to come into November numbers, and then you're going to come into December consumer spending patterns. And you had, as you rightly said, you had Black Friday, you got Cyber Monday, you got the holiday season. People generally this time of the year spend more out of their pockets than they normally would do as they come into the holiday season. And that's certainly, we're seeing that through the consumer spending behaviors. We're also seeing that through the GDP forecasts. The Atlanta Fed has also increased their forecast for the quarter four up to 3.2%, which is significantly higher than where Q3 was at 2.8. So it gives you a bit of an idea. There's a lot of positive momentum that's happening in the market, and I think that's being led in part by the labor market, the tight labor market. Wages are increasing, and the unemployment rate is still remained at a relatively all-time low. It's not at the lowest point we've seen it, but certainly is very low compared to the last 20 years. And so it's a question of saying then, well, what concerns would a consumer have? Now, there are two elements of this. I think the labor market does have some signs of a crack in it. One of those signs in the crack market is it's taking people 20% longer to find a new job than they did a year ago. So I think what we're seeing is the number of job openings in the marketplace is roughly around 7.5 million, and that's been holding relatively stable. And so companies are not looking to recruit dramatically right now. They're taking a hold and wait and see pattern. And therefore, employees who are working at organizations are also taking that approach. Like, whether I like this job or not, I'm just going to stay here because it's taking longer to find a job. So I'm not going to quit now. I'm just going to stick it out. And I think we're seeing that hold pattern evidently through. So that's one area of concern that we have in the marketplace, and one interesting area that's worthwhile keeping an eye out on. The second part of it to keep an eye out on is the savings rate. And for the first time, I don't know how many years, we're starting to see savings rates increase again. Yes, it went up from 4.1 to 4.4, so it's not a dramatic increase, and it's still well below the average we've seen in the last 2 decades, but it is creeping upwards. And if that number were to continue, it would suggest that the household finances of the households in the U.S. are generally getting better, and that's been driven in part by the wage inflations that we're seeing, and the union renegotiations, salary increase negotiations. So people are generally feeling a bit more positive about it, and they're spending accordingly. So those are two things to keep an eye out on. But there certainly is a lot more positive news than I had anticipated at this time of the year. And sort of indicating maybe inflation is going to go up again in Q1, and it's going to break maybe even the 3% barrier mark, which then would put the pressure on the Fed to say, well, yes, everyone's expecting a rate cut in the meeting next week at the FOMC, but will there be more in January? They might take a hold approach to that to see what some of the economic data comes out at.
That's super interesting, right? So we're looking, everything is extremely positive, right? As we go into the new year, 2025, the economy is strong. It's growing faster than expected. The consumer spending is up. So consumer, which represents what, nearly 60, 70%, 80, 70% of GDP in the US, that's up, right? So GDP should be growing associated with consumer spending. Savings rates are up. So I'm spending more and I'm saving more. So that must mean I'm getting more income from somewhere. Either that's coming from wage increases, as you mentioned, or it's coming from asset appreciation, e.g., my stocks are going up, my Bitcoin's going up, or my other asset classes are improving, right? And which is allowing me to save more and spend more at the same time. So live better.
Mm-hmm. Yeah, and I think you look at the stock market, look where the S&P 500 is, you look at where BTC is, you look at other asset classes, they've all performed significantly well in the last couple of months, and even throughout the whole year. But I mean, I think in the last couple of months since the election, the U.S. election, and having Trump being elected as the president-elect, I think people took that as a very positive message, and the markets have responded accordingly. And there's a lot of positive side. You look at the S&P 500 quarterly earnings announcements that came out last month and trickled through, a lot of positive news. And I think it's all driving to this wealth generation that's beyond just wages, but it's also the stock market that's adding this increased optimism from a consumer confidence standpoint of view.
Yeah, so that's, and I think the confidence is there for the next year. I think that, you can feel it in the market and on the ground. Everybody's pretty bullish and excited and hopeful for 2025.
So then the other thing is, then the question you have to ask yourself is, well, what's happened to debt, right? Was household debt still increasing? Because if we're saving more, you would expect to some degree household debt coming down a bit, or maybe they're not paying off. And what we're seeing is, household debt has increased. It's now a new all-time high at 17.9 trillion. Wow. It's the 10th consecutive quarter of homeowners borrowing against their equity, right? With home equity rising now to about 387 billion. So, there is still signs that there is still, although there's a lot of optimism, there's still areas that we need to be concerned about. If you look at credit card balances, auto loans, you look at student loans, mortgages, they're all up, right? And quelle surprise that the delinquency rates are up as well. And I think this delinquency rate of going up from 3.2 to 3.5 is is not 100% accurately projecting what delinquency rates are, because student loans don't get reported until quarter 4. So, that number is most likely to shoot up further because we believe that the number of students that will be delinquent on their loans. And so that number would likely go up, but not a significant amount, but it probably will go up to maybe 3.7 when we see the next report. But within all that news, yes, people are borrowing more, taking more money out. What is interesting is that there are two factors that's really interesting in the household debt levels. Is one, credit card delinquency rates, i.e. balances of 30-day plus, are actually down. So people seem to be taking this extra cash that they have, whether it's from the wealth, from the assets that have shown some appreciation, or whether it's from wage increases, but they're taking that, they're spending more, and they're paying off some of their credit card balances, which is a pretty unique position to be in. And that suggests that there is a lot more positivity that for us to be looking forward to. Now, this is the early stages still today, but that's certainly a sign. The second sign that's positive that's coming out of here is, despite the debt balances going up, it is today, of a household level, the total household debt balance is at 82% of their income. It's still a huge amount, but it's down from 86 pre-pandemic levels. So forget pandemic, but pre-pandemic, we're still lower today than we were at pre-pandemic levels. So I think that has certainly given us some optimism that households are now starting to prepare for down payments of their debt, and then removing the debt from their burdens that they're facing on a daily basis.
So unlike governments that are operating at 130% of GDP, households are actually working. I want of tax income, right? Because that's the income the government has. What are their operating budgets compared to households are very diligent and staying within 82 to 86% or 82% of their household income is actually, so is in debt. So that's, and that's servicing that debt. So they're actually managing to easily be able to sustain their debt. There's not much buffer, but I guess the saving rates are growing, right? And so that's helping build that buffer and bring it down from your 86% down to 82%, which is good to see. Healthy
We're early
progress.
stages. I acknowledge that this is early signs that we're starting to see, and there's progress that happens. So it's now making sure that trajectory continues. But those are some early signs that are positive to see. I think if you look at so that gives us the overall macro picture of where inflation is going. I think there's potential some risk to the upside in our view, that inflation will be growing faster and growing higher than what we had anticipated in our quarterly forecast. But certainly, it seems that there's positive momentum there. I think if we look then drill deeper into the inflation, where are we seeing some growth, what's happening? I think there are three major categories that are driving things upwards. And those are food, health, and household durables, right? Food is interesting because it's across food at home and food away from home. So like grocery store shopping versus dining out, they're consistently going up, which tells you that there's a broad-based spectrum of cost prices that are affecting the whole industry, whether that's commodities, whether it's labor costs, a whole bunch of other factors, the transportation, logistical costs, and so forth. But it's a broad spectrum affecting the whole industry. And so that shows us that there's some consistency in those food prices. The second factor, of course, is health. We spoke about health earlier, and this is going across the whole health category. Whether you look at insurance premiums, whether you look at medical services, whether you look at drugs, whether you look at general medical expenses, insurance premiums, and so forth, they're all rising, and they have been rising consistently over the last 5-10 years. And it's not going to show any signs of slowing down because of, yes, there's legislation issues, there's administration issues, there's labor costs, there's innovation costs, there's, premiums costs, there's all these factors that are affecting health. And on top of that, we're an aging population. So, that's all going to impact that. And that's going to continue its trajectory. And then you have a third major category, which is household durables, which we spoke about earlier, which I think are driven by three factors. One is material costs, premiumization, and inventory challenges that they're facing. And so I think somewhere in the durables industry, which are the white goods that we spoke about earlier, whether it's a microwave, an oven, a refrigerator, a computer, blah, 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 I think people are trying to get into that to avoid future price increases coming through. So those are the three major categories showing upward trajectories.
Yeah, food alone is about 15% of household spending, right? And then housing is another 25% on there. So if housing is going up and foods are going up, you're looking at a big chunk of nearly 40% of household expenditure being allocated towards those two categories.
Yeah, so housing is an interesting one. So overall housing is seeing a bit of a decline. For the way we define housing is we have short-term housing, things like hotels, Airbnb. We have rented housing, you have owned housing. And so if you break those three subsegments down, the owned category is continuing to increase, right? And we've seen a major shift in housing inventory available, especially in the existing home inventory. I think you're looking at things like mortgage rates now starting to come down again in December. So there is a combination of wealth accelerating, prices holding relatively stable, more inventories coming in, and therefore more sales are coming in. So the owned housing is starting to trickle upwards again. But if you look at rented and the hotels and Airbnbs and those guys, they've certainly taken a hit in the month of November, which we expected because you're coming post the election campaign trails that we saw in October. And so therefore they are coming downward on the trajectory. But you're still experiencing on an annualized basis, 1.5% increase in the total housing category. So that's certainly still pushing inflation upwards. And then you have transportation, and transportation has got quite a volatile category in here, which is the gas prices that you pay at the pump. And that's based 50% of that price movement is based on the movement of where crude oil prices are going. And, crude oil prices in the month of November have been coming down. And so therefore that's dropping down gas prices, which is a considerable impact on the households in the US. And then you take that, and that side of it is really pulling the overall transportation costs down. But interestingly, for the first couple of months that we have seen in a long time, is that vehicle prices are now continuing to rise. And that is a pretty unique position that we have not seen in the last 2 or 3 years. So it's a good position to be in. And so it seems again suggest that people have delayed their purchasing of previous cars because of the insurance, the auto loans and the car insurance premiums and so forth. And people with having more wealth and more income, more asset appreciation that seems to be funneling through into some of the purchases that we're seeing as well. So a bit of a mix. These are the sort of category highlights that we have, some upward trajectories, some downward trajectories. But overall, we're seeing definitely a more shift to the upward trajectories. And these are the major shifts that we're seeing across all the categories.
And transportation is a big category, right? So nearly 20% of household spending is in transportation. And it's largely led, as you mentioned, by oil, right? So Trump's drill, baby drill, is going to bring down the prices of oil, right? Which actually, if you look, since September, we've seen a rise in oil prices, right? And so ultimately driving a lot of that inflation and household spending. So if that can come down, it should significantly accelerate the sale of cars and vehicles. And if interest rate comes down, it'll allow for additional cars and vehicles. And that'll ultimately have a drop in airline costs and transportation costs overall. So interesting. Yeah.
Yeah. And logistical costs as well for the shipment of goods and services across the US, right? So it has a widespread impact.
Supply chain, right? Yeah.
Yeah, exactly. So I think it's, and what's interesting here is that, yes, we're certainly expecting as of January with the drill, baby drill policies that the Trump administration has been touting as their policy campaigns. I certainly think this is one of the categories that we see a potential, not necessarily deflation, but a downward trajectory of a deacceleration of gas prices, and that continuing to go into the new year, which will be a good thing to offset some of the upward trajectory pressures that's on inflation, whether it's healthcare, whether that's household durables, whether it's housing, whether it's food. It'll be offset that. And with the demand growth that we're expecting, it'll be a good thing to have some downward pressure on inflation as we go into the new year.
Yeah.
And then, we look at where we look out for the remaining part of the quarter. So Truflation does a monthly forecast for the preceding 3 months. And so we're showing you here what our forecast was in September for quarter 4, so the end of December. And right now we're right on target what we expected. This hasn't changed in the last 3 months. And we're expecting inflation to come in at 2.8% at the end of the year. If anything, we're seeing more risk to the upside than the downside of this number. But we've been very consistent in holding that number, and our quarterly projections are generally pretty damn good. And I think, what is the concern of that upward trajectory, of a continued upward trajectory, is a demand-based inflation, right? We're seeing the shift moving away from supply-based inflation that we saw back in, during the pandemic, when no products were being shipped anywhere around the world. People were stuck at home and they're spending a lot of money. And now we're seeing the opposite, whereas it's not supply-driven, it's now demand-driven from a consumer. Supply chains have been replenished, restocked, and now we're seeing demand-based inflation coming through. So what is driving that both in the short term and the long term? Some of the longer term aspects of things like deglobalization, the impact of tariff increases. As a result of that, there's going to be more onshoring. And with that onshoring comes then the cost of labor, which is more expensive than in the offshore markets. And that will certainly increase the price of products that we're seeing. It will also benefit the labor market, who will have greater incomes and have more money to spend. That's certainly one factor. I think the second factor is deregulation. Part of the Trump policy campaigning on the campaign trail was deregulation. I think the 3 main industries that are going to benefit from that: it's the energy, it's the healthcare, and it's the crypto market. The financial markets will benefit as a result of that. But those 3 sectors are certainly going to benefit the most. And it will certainly fuel, hopefully, some greater appreciation in the markets. And that will no doubt translate back into how the consumers feel about the state of their wallets and their household finances. We spoke about the energy and the energy prices and drill, baby, drill. So that gives you a bit of depreciation. But I think those 3 factors will certainly increase it. I think you've got the other factor that I didn't mention, and apologize for that, is the immigration, right? And I think it's going to, the focus on immigration policies to remove undocumented workers from the U.S. will certainly reduce the available labor pool, and that will increase prices as well. So we've got to be mindful of that. If you look at the agricultural industry today in the U.S., it's not saying that the current administration or the incoming administration is against migration coming to the U.S. They're not, but it's more of a controlled migration. And so we're expecting that to have the removal of undocumented workers and other immigrants will certainly have an impact on the available labor pool, which will jack up prices over time. So I think in the short term, the areas that we need to be concerned about is the continued tight labor market, the salary increases, right? And so we've seen some salary increases, but don't forget the long-term trajectory of all these union negotiations that have happened, whether it's the most recent negotiation at Boeing or the port authorities in the South, or whether it's the FAW, the auto unions, doesn't really matter. They're long-term gradual increases in salaries. And so, you're talking about 4, 5, 6, 7-year contracts that people are going to get salary increases for. And that is just going to flow back into the market and hopefully, or no doubt, will drive this sort of demand-based inflation as people pay off their finances, their debts that they're incurring, and also you feel better with having more pay in their wallets. And I think the secondary factor we've got to be concerned about is rate cuts. right? And lower cost of borrowing will just fuel demand, and therefore that will translate into inflation. Now the question is, of course, how far will the Fed go in terms of the rate cuts, and what will they do in December versus what they do in Q1? I think the market, 80% of the market is baking already in a 25 basis point
25 basis
cut.
points.
And so now the question is what happens in Q1, right? And I think December 1, my assumption is December 1 is pretty much baked in. They'll do a 25 basis point cut. But I think when you get to January and February and March meetings, it might be a bit of a different story.
So that's interesting, right? I mean, we have December 18th. So we talked about December 11th. And then we have where the BLS will announce at 8:30 a.m. again, Eastern time on December 11th. You also have on the December 18th, the FOMC will announce a decision associated with up or down or stay interest rates, right? And we've seen a very healthy economy. You see growth everywhere across the board in terms of spending power, savings going up. And how, what is your, I mean, we'll have a separate call on the FOMC meeting later in next week as we've got enough with inflation. But why do you feel the market is anticipating another 25 basis points drop, given what we just spoke about now?
Yeah, I think it's just been baked in long term. Everyone's assuming that inflation has come down. I think the Fed has said they wanted a 2% target on inflation. My read and interpretation into Powell's statements about where the Fed is going is they're sort of happy around a 2 to 2.5% on core inflation on the PCE metric that they use.
Yeah.
Now, I think we're going to be exceeding that, but I think overall the economy is doing progress. There's some signs of indication of the employment market holding steady. So I think the market's just been assuming that they're going to be a rate cut because inflation has come down from where we were at the beginning of the year, and that's what they've been expecting. I think when it comes to the current economic data sets that come out this week and then next week, I think the Fed will have more food to consider and to digest, and more data points to digest, and more content to see what's happening. But I think overall they seem relatively positive about reducing by 25 basis points. I think by January, though, I think we're start to see a different figure, because if the PCE number comes out at the end of December for the month of November, I think that will give the Fed more things to think about, and they might hold the January number, and they won't reduce it so much. I think there's also the secondary factors, my viewpoint, is the cost of borrowing to the US debt is also a consideration which they're taking into account.
Yeah, I think, I guess, that must be a big impact ultimately, because that's hitting the P&L, right? I mean, the $36 trillion in debt at that specific interest rate. Not all of it is at the latest interest rates, right? So it's only sort of in the last, let's say, 24 months that you've experienced such high interest rates. So that portion of short-term loans are at that high interest rate.
Yeah, but I mean, it's mind-blowing that in the month of September, October, and November, or in September, October, we don't have the November number yet, but September, October, we've increased the debt by another nearly $750 billion in 2 months. And it's sort of like, well, where the hell is this coming from, right? Yeah. We're meant to be controlling the debt, and now we're issuing $750 billion of new debt on top of the 32, 33, 34 trillion dollars that's out there. It's just getting too big. And so if the American households know how to try to work on rebalancing their debt, the question then becomes, at some point, the U.S. government's going to have to figure out a way. And I think the Fed is concerned about that, and therefore trying to bring down interest rates will hopefully manage that in a more effective manner.
One of the interesting metrics that came up was the desire to drill, baby, drill. In order to have an impact, you need to actually be able to increase production of oil and refining of that oil, by the way, to about 3 million barrels. Mm-hmm. Is the drill, baby, drill strategy enabled, can it actually drill that much? Can it actually produce? Can the US produce that much incremental increase in global production?
Yeah, I mean that's the big question, right? I don't know if they can drill 3 that volume of capacity, right? They're looking to sell, 30 million barrels of crude oil to offset the disruption of the supply chain. They've managed to do that in the past. Whether that goes now further, where we go now, and what the U.S. is able to do, it's a big question. I think they have the capacity. They've been
Yeah.
increasing the strategic reserves. They've been investing in the infrastructural setup for oil, for the oil infrastructure. So whether that reaches that mark or that level, that's another discussion point. But the capacity is there to increase it further than what they're on today.
Yes, so that's a lot of interesting insights. The space of the economy, where we're at. I think there is a tremendous upside as we go into 2025. Just to wrap up on your insights of the historical data and looking forward into 2025, what are the two maybe big things that you see for 2025 based on all the data that you're sort of going through? Where do you see opportunity? Where do you see challenges? Or what are the two big things that are really going to move the markets in 2025?
So yeah, I mean, from a data standpoint, there are two areas that I'm concerned about. Well, two areas that I focus on, not concerned, but focused on. One is the big themes that come out for me going ahead into next year is this notion of how much demand growth are we going to be seeing in the U.S. economy that's going to fuel the retail sales, the consumer spending. How much is that then going to translate into how much savings people are going to be accumulating again? All that whole discussion we had earlier. How much to the upside are we seeing that going to be happening, right? And all the consequential impacts that it has downstream. But if the U.S. consumers are feeling much more confident and we're feeling much more willingness to spend, and the fact that we're not going to go into recession that a lot of people are predicting about, and you feel more confident about your job security, that risk to the upside becomes a lot bigger. So the question, in my view, one of the things that I'm concerned about looking forward is how much the risk to the upside. And you note that I'm not using the word to the downside. For me, it's all to the upside, right? So how much more to the upside are we going to get, right? And I think there is quite a lot of room for it to move to the upside. That's one major theme that I'm looking into 2025.
So if you would summarize that, it would be make America wealthier.
Yeah, exactly. Let's follow on suit. But yeah, 100%. And I think that will fuel demand, or fuel a whole bunch of other factors. But yeah, so the upside of that demand is the big concern, a big area of focus. I think the second factor is, for me, is the US debt. And how do they manage that? So, and that's going to move other factors, but you got interest rates associated with that. Where does if the demand keeps on fueling, where does the Fed go with interest rates? How do you service the debt? At some point, this debt's going to have to get serviced, right? It just can't continue to grow. And the assumption, of course, is that you grow the economy fast enough to reduce the level of debt that we have as a percentage, right? And if the GDP grows faster, the question then, in my view, is how much faster does it need to grow, right? Because it's already, if it comes in at 3.2%, to me, that's a pretty humming economy already, right? So how much faster does it have to grow, and how much faster do people think it's going to grow to service that debt? And that's the secondary factor that I think we need to keep a close eye on as we go into 2025.
I think we'll see a really fast transition in terms of new administration coming in. That will result in a significant cut in regulatory bodies and administration, which is going to allow to create. It's going to need to create more private economy jobs. and those ultimately should further on, sort of the economy. But when will that kick in? How long is that time lag before entrepreneurs and startups can actually let their businesses rip? And what does that rip look like from a growth perspective? I think, yeah, coming off a huge base. I mean, we've been looking in the past at various graphs where you look at the productivity per employee in the US compared to the rest of the G7. It is leaps and bounds above the rest of the world already. So is it going to accelerate even further?
Yeah.
And what does that look like, right? I mean, how does the rest of the world be able to keep up? And will they be able to keep up, right? Who, other than China, nobody else will be able to keep up, right? And China, thanks to its 996, they'll work twice as hard than anybody else to keep to do that, right? And Europe, I mean, is really going to struggle.
No, 100%.
Anyway.
But yeah, I think those are the two big themes for coming to 2025.
Yeah. So that's make America wealthier, and yeah, how fast is it going to grow? I think it is really right. So those are two aspects to look forward to in 2025. So thanks, Oliver, for your insights, and yeah, hope you guys, everybody, enjoyed this. Yeah, and if you have questions, comments, please follow us on Twitter, YouTube. If you want to, if you don't want to, then don't do that. But ultimately, this is where you get some interesting insights. I hope you enjoyed that. Let us know. Subscribe, like, do all the things you need to do. Thank you very much, and have a happy Tuesday, and see you again on Thursday. Thanks, everybody.
Thanks a lot.